Hello, and welcome to another episode of The Influencers. It's a special episode today. We're here live in London for our Digital Asset Summit, where we're going to be looking at the roadmap to the mass adoption of digital assets in financial services. I'm Sharon Lewis. I co-chair our digital asset and blockchain practice alongside my fellow partner, John Salmon, with me. And I'm also with Lawrence Wintermeyer, the co-CEO of Global Digital Finance.
Great, thanks, Sharon. As you mentioned, the topic of the Digital Asset Summit is institutional adoption by financial services of digital asset technology, and it is very exciting. We've got an amazing lineup of speakers, right across buy side, sell side, some of the infrastructure players, and the importantly the regulators and policymakers that can hopefully make this all happen. Lawrence, what are you most looking forward to in today's Global Digital Asset Summit?
Well, it's always great to bring together the community, and we've been working at this for 7 years. We've had 5 summits. I've been trying to do the maths. I think we must have had to leave one out over COVID because we should be at a run rate of somewhere around 6. But I think the importance of that, John, and then of course we've all worked together in the fintech ecosystem with Innovate Finance back a decade. The importance of that is that really, we've been working with fintechs and institutions for near a decade focused on this topic of adoption. And it's moved pretty slow. Well, why has it? There's been confusion about what digital assets are, from native cryptographic assets to tokenizing real-world assets. There's been quite a bit of regulatory friction. Clearly, payment rails are sorting themselves out. Digital custodians, which you and I coined the sort of Gordian knot of digital assets back in 2017, those solutions are coming through. So I think what we're seeing as we go into this year's conference is all of the building blocks from the supply chain in space. And then, of course, we've got the great success on the buy side of things like the Bitcoin ETP and the BlackRock case study, fastest growing ETF in history, really making a case for digital assets. So I'm really looking forward to hear what all of our fintech and institutional partners have to say about what they're focused on in 2025. GDF responds to its members from survey-based content and their priorities. And so we're at the time of the year where we're trying to get a handle on what the agenda looks like going into 2025. And I think with macroeconomic uncertainty, it's not entirely clear where those big mass adoption drivers are going to be. So hopefully we'll get some more context on that today.
Yeah, and I think the regulatory and policymaker environment that you mentioned earlier on is looking more positive. I think we've got MiCA coming in force next year. We've got UK regulatory regime coming in place. Some exciting developments like the Digital Security Sandbox. I think you also did a survey, didn't you, Lawrence, on institutional adoption and what members were saying. What were the key takeaways for that?
Yeah, well, on the back of the BCG survey, UI Parthenon data kicking around the community, and particularly Larry Fink talking about tokenization of real-world assets being a 16 trillion opportunity by 2030. We independently surveyed 100, particularly asset managers, both buy, sell side, folks in the supply chain.
Yeah.
And that was conducted earlier in the year. And overwhelmingly, 4 out of 5 are scaling up their own innovation teams and infrastructure team for digital assets. Almost 100% of them claim to be engaged in the digital eco asset system to some extent, with I think 97 or 98 of them claim to handle Bitcoin in some capacity, which really surprised us. And then maybe not as surprising in terms of the tokenization of real-world assets, debt seems to be the first taxi off the rank most folks are voting for. And so I tie that in, Sharon, to discussions we've had. And then again, looking at the work you've done on fixed income and bonds and the tokenization of the fixed income community, which we know is probably moving fast on, the fastest moving asset class on the sell side. We don't see as many regulatory barriers in that space But there are some nuances, I think, in major jurisdictions that you've pointed out in the work that you've done.
Yeah, and I'm really excited this afternoon to be chairing a session looking at the comparisons between the different jurisdictions. I think quite exciting. And it is amazing to see how things are progressing in these different jurisdictions. In Europe, for example, Germany has made a very big step with the issue by KfW of its bonds. You need that leading institution to step forward and create that path. And the interesting thing for me, however, is that a lot of this is happening outside the regulatory markers. So outside MiCA, outside using really the traditional regulatory space to advance, because quite frankly one can't wait for regulation.
Yeah, and I think that is the challenge that in adoption. I think the biggest challenge that with the banks still find is that regulatory uncertainty, and I think they'd rather stick with what we currently have, right, and keep it very safe. And I think to see the real innovation coming through, I think we could do with more support from some of the regulators. I'm very encouraged by the Digital Security Sandbox and the direction of travel. And Sharon, you and I have had some great dinners with some of the banks and others looking at the opportunities there. But we're waiting to hear from the Bank of England on the direction of travel. But it's by no means certain that that's going to be what the institutions want, because they want the ability to go in quite big, and the current proposed limits may stop that, right?
Yeah, there's lack of scalability within these sandboxes. So I think that is something that will have to develop over a relatively quick period of time.
Yeah, and you there are a number of good points here. If you focus on the U.S. market and look at the proposed SEC Staff Accounting Bulletin, SAB 121, most institutions would say, well, boy, it's not a very level playing field when unregulated firms in the digital asset space can do what they want, but we're going to be punitively charged with a blockchain tax for holding these assets on our balance sheets. And I think that's an important part of what's emerging in 2025 on this regulatory note. From my personal perspective, in speaking to institutions and coming back down to securities, and then again as a securities and securities derivative guy, most of the players I know say, well, look, securities are regulated, we know securities, so we're happy to develop infrastructure. Where there's a gap or a rub or a conflict is that securities from brokerage to settlement don't happen atomically in real time. And you don't need blockchain or digital assets to do that. Technology can do that. But it's that intersection of how this new enabling technology can compress time, get costs down, improve liquidity, improve collateralization, but it's still stuck in a regulatory framework that was developed when we had carrier pigeons and wires. So that really needs to be sorted through. And I think folks, Sharon's point about the restrictions on sandboxes, particularly around securities, is an important one. But hopefully we're at a point where with the UK Digital Securities Sandbox, it'll react to constraints in a productive way, particularly where we need to see legislation change as a result of significant barriers that are preventing assets to work correctly in this new environment. So I think that's pretty encouraging.
Yeah, no, I think that's a good point, Lawrence, and I think we're all pretty optimistic and positive, aren't we, about where we are? I think the institutions are very keen to adopt this technology. They see it saving costs, being better for customers, and I think there's lots of good points. And I think from a policymaker regulatory side, I think they're beginning to understand that this is not crypto criminals that are operating outside the system, and there are really important use cases for this. So it feels like everything's going in the right direction. It's just a question of timing and making sure that we can best move this forward together.
Yeah, and if you mentioned, Lawrence, the fintech space. 10 years ago when we talked about fintech, people rolled their eyes and thought, well, what is this to do with me? And yet today, fintech in the retail banking space has become very much business as usual. There are still fintechs bringing new products, but globally the banks themselves have become fintechs. We all bank online, and all that happened really quickly without people really thinking about it, largely driven by COVID. I truly believe that fintech is going to go into the wholesale banking space, and there is no, I think, better illustration of where that will happen, really in the digital asset space, particularly bonds, securities, derivatives, and the tokenization of real world assets.
Well, you raised so many great points there, Sharon, that I think are at the heart of what will help further scale digital assets into 2025. And so, 10 years ago, when I was chairing the industry sandbox consultation at Innovate Finance for the FCA, and Hogan Lovells were on the steering committee, most of the financial institutions didn't want to participate with fintech, and there was a real issue in the ecosystem getting them to work. And I kind of liken the relationship with fintechs and banks to that of carriers, national air carriers, and low-cost airlines. 10 or 15 years on, all of the national carriers use all of the same tools that the low-cost airlines do, and the experience has been transformed by lower-cost airlines. But a lot of the national carriers are still there. It's not as if they've gone out of business. They've adapted, and they've almost become low-cost airlines themselves, other than inflation and fuel costs that we've seen post-COVID. And so I think that your point is absolutely right. As long as that innovation continues, and we've seen certainly the growth in cap markets, fintechs, in the past 5 years, the biggest issue with innovation is that with inflation and no free money, fintech investment is down, and innovation theater is struggling a bit. So I think, from a macro perspective, most of us, certainly in the West, are hoping that we can get interest rates down and certainly get back to a more reasonable level of funding innovation, a lot of which is destructive capital. And so we used to think, boy, it takes 10 years to develop an ecosystem. Well, we're 15, 16 years into DLT, thanks to Bitcoin. It probably takes closer to 30 to really transform the plumbing of the infrastructure. And then the benefits that do flow through to consumers and society are ultimately great, and they've not borne the cost of all of that destructive capital. That happens in the ecosystem, and consumers hopefully just get the benefits of that sort of stuff. But long may that sort of disruptive innovation continue to drive adoption.
And I think in addition to sort of like inflation, interest rates and the like, I do think that there has been this other sexy little thing that's come along in the form of Gen AI, and that has actually also sort of made people think about where they're putting their money, their investment, and that's diluted a little bit the focus. But I don't think that even though that has happened, that changes ultimately what needs to happen in the financial services area in relation to digital assets. It's not just Gen I which will take out these costs.
Yeah, I think it'll be very interesting to hear what the BIS folk, the Bank for International Settlements, are talking about with the Finternet. We've got a great keynote from Francesca today, and I think it'll be very interesting to hear from some of the regulators and policymakers on how they see this, moving through as well. I think there's a lot to look forward to today, right, guys?
Well, indeed, and just to pick up that point on Gen AI, that's an important one. And again, there's too many interesting things to speak about, so to try to keep it really pithy. It's not a fintech space. You really need to have deep pockets in that Gen AI large language model space. Yeah. But for most folks that have been involved in bigger data machine learning, right through to AI and heuristics. Regulated financial services, and we were talking about the compliance challenges earlier in the digital asset space. Regulated financial services I liken more to like a Six Sigma control environment. It's pretty difficult to get things into production for clients without having gone through a lot of production testing, product committees, etc. And so, the whole idea of large language models is not suited for highly regulated environments. We're into smaller language models. And I think the domains that folks like us in Reg FS are comfortable in dealing with. So there's a bit of a storm in a teacup. We're certainly, impressed by some of the language characteristics. And I think certainly law firms have a lot to learn from LLMs and what's going on in that space. But I think most of the institutions that I hear speaking about things are reasonably tempered. Yeah. The interesting thing about Gen AI is how it transforms either consumers or investors in the access of the choice of the data that they're looking at before they even go to providers. So I think that's something that bigger asset managers, investment managers are focused on.
Yeah, I think that's a great point, Lawrence. And I think the financial institutions on the one hand are very keen because they see this as another digital infrastructure that saves costs and creates better products, but at the same time very concerned about governance and risk, and to have inherent bias and discrimination built into the system. And it's you have to really be very careful on this, right? And as you say, there are lots of committees to go through, et cetera, et cetera. So, I think it's again, encouraging technology, but lots to think about.
Yeah, but again, I'll come back to the retail banking space. They were worried about all those things in relation to adopting fintech. And yet we all now bank online. Who has a checkbook? And that has happened in such a short space of time.
If you think back to the days when the internet first came on board, I remember speaking to banks and they said, well, this internet stuff, great, really good, but we're never going to transmit money, right? We're never going to do payments via the internet, and you kind of, there's a lot of we will never do, right? And guess what? We figure a way out. As you say, Sharon, it's about figuring out a way to do this without risk and actually getting the best of it.
Yeah. I actually did the first green bond probably more than 20 years ago. And again, nobody thought that was very interesting. Who's going to do that? And actually, again, today it's business as usual.
Yeah, well, it does argue for handing off all of these competencies to your children, because there's only so much you can do in one innings in your career over 20 or 30 years before you think, gosh, we've not really moved the dial as much as we thought we would. We need to hand off to the next generation. But John, I'd love to pick up on this point you make about payments, because for me, a very big part of mass adoption in fintech started in remittances. Yeah. And I loved it because it was almost a hijack play on institutions in that, you signed up online with a remittance firm, but you needed to have a bank account. So your KYC was done. And they were actually using the benefit of the fixed cost infrastructure to take a spread quite often off of the currency exchange and get it to the destination. But there was no infrastructural change. It was an innovation play on top of the current banking rails. And like to your point, Sharon, now all of these years later, banks aren't charging you £40 or 8 or 9% for a foreign transfer. So you can see the impact of those things. But I think it was when ClearBank launched here in the UK, and we started to see the greater introduction of DLT, that we started to see the infrastructural change. And so I only note that in that, we do, the three of us do work now in Westminster with the All-Party Parliamentary Group for Digital Finance. And the message that keeps coming back is you need to make this more compelling. And we keep saying, gosh, changing the plumbing is pretty unexciting. And then, John, the discussions we have, it's a bit more like the Japanese Kaizen of hundreds of performance improvement, or it's business as usual now. There isn't a big lightning bolt and a big change that's going to move society when you're replumbing the infrastructure. So I think that's the thing that we've really had to learn to become a bit patient with, because again, I take back to the stuff you and I've been doing on codes of conduct for 7 years. It just takes quite a bit of time to get people used to these.
Well, one of my sort of earliest fintech projects was a plumbing project, which you and I have talked about before, which was for the wealth management industry in the UK. That at the time, if you had an independent financial advisor and you wanted to know how much your pension was worth, you had to phone a call centre, and they had to. The IFA, you'd phone your IFA, the IFA would then have to phone a call centre at Aviva or whoever, and they would have to fax it or telex the number. And guess what, right? A lot of the time they got it wrong, right? Or they couldn't find your account or whatever. So what we did was create a legal framework to ensure that data could be sent between IFAs and product providers in a secure way where, the liability is very clear if someone messed up, right? And, that seems totally obvious now, right? You can go into a portal and get that. But that infrastructure, that legal infrastructure and the tech infrastructure is still the same as it was 25 years ago. It was all XML messaging, it was all very straightforward. But actually, until you did that, right, everybody was saying, because at the time it was done with third-party web portals as well. At the time, people were like, how are we going to do this, right?
Yeah. And I think, the European Commission has published its report on competitivity in the capital markets. And one of the focuses has been on securitization.
Yeah.
Well, 20 years sort of in the weeds, securitization very much has been limited to those well-known originators, well-known products, and many have left the securitization market and many have never adopted it. And quite frankly, it will be very expensive to do securitization for new entrants without mass adoption of technology. And blockchain, to me, particularly for the tracking of receivables and the like, is one of the keys to unlocking the securitization market.
Absolutely.
I think it's also one of the keys to scaling ESG. Again, lots of different rules, lots of different regulations, different jurisdictions, but ultimately what it means is a huge burden of reporting, transparency and the like. And I think that these type of things will have to drive this market.
Well, you raise such a good point, and it's the benefit of network technology, distributed ledger, and Web3, and most of the things that this community here are focused on. And it's Franklin Templeton's numbers, particularly around blockchain and mutual funds. And I can't remember them actually because the numbers and the cost savings are so big. The cost of a very large number of transactions on chain is the equivalent to the cost of one transaction now in the dematerialized world where we still have post-it notes and spreadsheets and XML or that sort of interface you've described, John. And that's quantum, and that's just the cost perspective of something that's actually a reasonable low cost asset class or product anyway. But I think these are the important things that, it's the plumbers in the community that get excited about this. In particular, capital efficiency, whether it's your balance sheet, whether it's liquidity, or whether it's collateralization, for governments and larger institutions focused on creating capital and generating wealth for society, which is certainly a big government agenda here now in the UK with a new government. It's through that plumbing and through that enablement that you've just spoken about, Sharon, that'll make that happen. And unlocking those smaller franchises and making it safe for larger pools of capital issuers to securitize what they're doing. So it bores a lot of folks at a cocktail party when the three of us are standing there and
I don't believe
they're like, don't go speak to those three.
This is like the video equivalent.
They're talking about securitization on blockchain again. It's so boring, but it's actually important, and it is. It's again, interesting to hear today how that's moving along from all of the folks that you've mentioned are speaking today, John.
70% of ESG reporting is done on Excel, which is remarkable. There must be something better than Excel.
Yeah. And I imagine, as Lawrence said, a lot of the big financial services organisations and their products is very expensive, and there's probably a lot of Excel and a lot of other pretty clunky technology that doesn't always necessarily fit together. Anyway, Lawrence, thank you very much once again for helping us with this podcast, and importantly hosting the excellent Digital Asset Summit. We're all very much looking forward to it, and we'll see you next time. Thank you very much.